This is Economy Watch, what you need to know about New Zealand's economic life today. Brought to you by interest.co.nz.
Kia ora, and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news that global manufacturing indicators have turned quite positive. First in China, their official March PMIs have set a bullish tone to start the week. Their official factory PMI rose to 50.8 from 49.1 a month earlier, and export orders also recovered. The official services PMI there rose to its highest level since June. These were followed by the private Caixin factory PMI, and that broadly confirmed the improved outlook and new expansion, actually a 13-month high. This apparent recovery energised the Shanghai Stock Exchange yesterday. In Japan, industrial production fell and their jobless rate rose, both not expected, but that data was for February. For March, their central bank sentiment survey of mostly large businesses remained broadly positive. And in South Korea, industrial production rose and by more than expected. Back in China, the slow-motion real estate sector crash rolls on with more troubles at both Vanke and Country Garden. It is more of them than that, of course, and banks that responded earlier to Beijing's call to them to support the sector are trapped in growing bad loans. Asset quality pressure is immense, said one major bank. In India, we should note a new ILO report that shows the jobless rate for Indian graduates at home was a massive 29%, almost 9 times higher than the 3.4% for those who can't read or write. The unemployment rate for young people with secondary or higher education was 6 times higher at 18.4%. This data reinforces David Hargreaves' point that even if New Zealand's local labour market struggles, it will still look attractive to Indian immigrants. It isn't our attractiveness that draws them, it is the job pressure at home that pushes them out. In the US, the widely watched ISM factory PMI has shifted into expansion mode on the strength of new order levels. It joins the internationally benchmarked S&P Global, or the market one, which was already moved into expansion the previous month. But it was the size of the ISM shift that got market attention, enough that the view formed it will keep the Fed from cutting any time soon. Both showed prices are no longer falling. It's not all good news in the US. Extend and pretend is back, especially in the US commercial office markets, and particularly for office buildings. The US Fed is on watch for financial stability risks, although they claim it is an issue for small and mid-sized banks, not the systemically important big banks. And staying in the US, Fed Chair Powell said that PCE inflation data for February was along the lines of what the Fed wants to see and broadly expected. However, the latest readings aren't as good as what policymakers saw last year, and the Fed can wait to become more confident before cutting interest rates. In fact, he said policymakers don't need to be in a hurry to reduce borrowing costs. The Fed's base case is for inflation to come down, but if that base case doesn't happen, the Fed would hold rates where they are for longer, he said. Today's PMIs reinforce that position. But he was responding to PCE inflation data for February, which rose 2.5%, and that was following a January 2.4% rate and a December 2.6% rate. Core PCE inflation rose 2.8% after being 2.9% in the prior 2 months. Powell and his colleagues won't be happy with these levels, but they aren't seeing downward progress either. Meanwhile, American personal incomes were 1.7% higher than a year ago, and personal consumption was 2.4% higher on the same basis. This is the first time income growth trailed spending growth in a long time. It is too soon to know whether this is a turning point or just a data blip. So perhaps it'll be a surprise to know that the University of Michigan Sentiment Index rose more than expected to its highest level since July 2021. In Australia, inflation expectations, which had been stuck at 4.5% since December, actually slipped in March to 4.3%. While this may be its lowest since October 2021, it does emphasise just how sticky Australian CPI inflation has become. Meanwhile, China has dropped its tariffs on Australian wine after years of sanctions that crippled the billion-dollar export industry. The US Treasury 10-year yield is now at 4.33% and up 14 basis points from the end of trading last week. And the price of gold will start today firmer by $7 than yesterday at $2,240 an ounce, but $26 below its all-time high reached over the past 24 hours. And oil prices have risen $1 to just on $84 a barrel in the US, while international Brent price is now just over $87.50 a barrel. And the Kiwi dollar starts today at just on 59.4 US cents and 35 basis points lower than this time yesterday. Against the Aussie, we're unchanged at 91.6 Australian cents. Against the euro, we're holding at 55.4 euro cents. That all means our trade weighted index starts today at just on 69 and down 20 basis points from this time yesterday. And the Bitcoin price starts today softer at $68,671 and down a sharpish 3.7% from this time yesterday. Volatility over the past 24 hours has been moderate though, at just on plus or minus 2.4%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.